Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Luke, welcome back to the show, mate.
Thanks, Alan. Thanks for having me back on.
It's always a pleasure, mate. It's always a pleasure because we get to talk small companies, we get to talk micro caps, some really interesting businesses. But many of our listeners will be aware you've switched roles, you've gone out on your own, you've started your own fund since we spoke last time. I'll include a link in the show notes for anyone that didn't listen to the previous episode with Luke. But maybe you can give us an introduction to Merewether. Tell us a little bit about how you found it. It's early days, market's been volatile. How have you found things running your own money?
Yeah. Well, when we did the podcast last time, back then I was still at Oracle Investment Management. Mm-hmm. And even in that podcast, a big part of our conversation was my professional work at Oracle versus I've always had a passion individually for micro cap and small cap stocks. And that was my online persona, Winnie, which we were discussing. And so, Merewether, I've had the opportunity, the fortune to be able to follow that, more individual passion and launch Merewether Capital. Right now, it's just the Inception Fund, which is a pure micro cap fund. So a real extension of what I was doing personally and had some good success with. Fund launched back in early December. So I've sort of half joked to a few people, I can hopefully look back in a few years and be the guy who launched his fund a few months before World War III. So we'll see how it all plays out. But it's been good. Going into it, I sort of was told by some people and understood the importance of making sure I had a good investor base who understood me and my process and the volatility that you would have, of course, the overall market, but with micro caps in particular. So I've been pleasantly surprised with my investor base and how they've reacted to the volatility. I actually I see it more as an opportunity right now than a massive risk to the downside. I have put a lot of cash to work since launching Merewether. So we'll talk about a few today, and some of them I've actually bought recently too, which is nice. But overall, it's been no short of interesting, but also some good lessons. And I think I've accelerated my learning. I sort of would have hoped to do a lot of these lessons over the next 3, 4, 5 years. I've squeezed them into 3 months, but it's all been very good.
Oh, well, if you can survive this, and you seem to be acting in a way, your temperament seems very cool and collected. I think you can survive the next few years too. Just quickly, it's is it wholesale only and $50,000 minimums to invest?
It is, yeah. Given the restrictions around that retail versus wholesale, the costs of a retail fund, we are wholesale only. But look, if anyone's wholesale investor sophisticated status, reach out, investors@merewethercapital.com.au. I can run you through sort of what we do and who I am.
Yeah, great. And there are updates, and there are a couple of company write-ups on the site too there.
Yeah,
so there's one on XRF.
I've tried to populate the website with some stuff. So merewethercapital.com.au, you can sign up for monthly notes. And every now and then, I've probably haven't kept up as much as I would like, but I'm trying to put out sort of blog posts on individual companies. And we've got XRF and Kit McGrath, which we'll talk about in a second, on the website. And hopefully do a few more of them. So gives investors, a bit of insight into the stocks I'm looking at and also how I maybe approach investing as well.
Yeah, great. So before we get to the 3 to 5 companies, you've brought 3 to the table. I've brought 2 slightly larger companies to the table. Maybe just to get your thoughts on reporting season. You alluded to it being very volatile there. We were going to record this a week or 2 ago, but you're away on holiday. I was away on holiday. So now we're doing it. And these companies stood out to you for some good reasons, I assume. But maybe just generally speaking, how have you found reporting season this year as opposed to years gone by?
Yeah, so I guess to clarify first, the 3 companies I'll talk about, I own them all in Merewether Capital, and they were sort of the 3 standout reports, which is why I wanted to bring them to people's attention. reporting season overall, I thought it was really interesting. On the whole, I thought it was quite positive. I thought it really showed the resilience of a lot of businesses in the face of a lot of moving aspects. They've been rehashed a million times, not only by businesses themselves, but also talking heads around inflation, interest rates, supply chains, commodity pressures, wage pressures, just this confluence of factors that could have impacted businesses, and some were heavily so, don't get me wrong, but I was pleasantly surprised with how many were able to buffet a lot of those challenges and put some resilient results out to the market. And commentary on the whole was, I think, pretty positive. Obviously, wait and see. And there's always reasons to be negative. And sometimes they do come out of left field, something like a COVID, and that's what can really shock the market. But I think on a whole, the ASX, and particularly where I play in that micro cap, small cap space, I think a lot of businesses have really come out of COVID quite strongly and are poised to do well over the next few years. The caveat to that, and I'm sure you guys at Rask noticed this as well, was you still had to do a lot of work under the surface with these results, though. So you rewind 12 months ago, the main thing we were doing was sort of trying to strip out the benefits of COVID subsidies and impacts and things like that. And now it's the opposite, where you're having some pretty clean results for the last 6 months, but their prior corresponding periods may have been boosted by JobKeeper or anything else. And so it's still a lot of work to try and come up with those clean comparisons and see how underlying businesses are really moving. But that's the fun part of the job. And I think that's the opportunity for investors who are able to do that. Then, what doesn't look like an opportunity on the surface, you do that little bit of digging, that little bit of scratching, and you see, well, there might be some sort of mitigating factors to some of these numbers. And what I like to term that underlying earnings engine of the business has actually improved, even if the headline numbers haven't. So I thought it was a really interesting reporting season from that point of view as well. And like I said, I as a micro cap investor, I love those sorts of reporting seasons because that's my opportunity. I know that a large part of the market in the micro caps will purely move based on whatever those reported numbers are. The opportunities where I can say, well, hold on, that reported number is a little bit weak, but I can sort of adjust for this or remove that. And I think that's where I always get my best ideas from.
How about in terms of, just one final question on this, how about in terms of like outlook statements? I think some people's fears are that a lot of the inflation impacts are not yet truly felt by some of these businesses. How did you find companies dealing with that from like a second half or full year results perspective?
Yeah, look, I think that's a fair statement that the numbers that we're seeing in the pipeline haven't flowed through to the businesses yet, sorry. I actually thought outlook statements on the whole were pretty positive. And maybe that's me setting my expectations from a COVID world. The last 2 years of most businesses actually just outright not providing any sort of guidance or commentary because of uncertainties. But like I said, in my sort of, I will admit, it can sometimes be a smallish bubble in that small micro cap space. I thought most companies were pretty positive on the whole. And I think the main reason for that is, even though you do have some of these uncertainties in the future, and inflation is the big one coming through, the recovery out of COVID for a lot of businesses probably has the potential to overwhelm those inflation pressures, and so the overall business can still ride that COVID recovery even through any sort of bumps that may come. But look, it's worth, it's always worth keeping half an eye on the macro. I'm not a macro investor myself, so I certainly don't position the Merewether Capital portfolio from a top-down perspective. I don't take a view on where I think the macroeconomics is going or commodity prices or interest rates, but certainly being aware of the environment, I guess more importantly, being aware of how individual businesses in your portfolio are positioned for the macroeconomic environment. And we can touch on one, and we'll talk about one actually with XRF Scientific being exposed to commodity cycles. They were one of the few companies that called out potential headwinds from commodity prices. So yes, I certainly, you keep that stuff in mind, but no, on the whole, like I said, I actually thought this reporting season was pretty strong, and that's, I think, creating a lot of opportunities because, of course, the broader market's been volatile and downside volatility in particular. But those fundamental reports, I think, have been pretty strong. So you've had the opportunity to, I think, buy businesses that are doing well, have just reported well, with share prices that have sometimes actually gone backwards.
Well, why don't we start with that? We were going to start with KIP, but why don't we start with XRF? So it's a fascinating little business. I think people maybe don't necessarily understand the business too well because it kind of gets like into the weeds of testing, laboratory equipment, consumables, X-ray fluoroscopy. People get a bit like tongue twisted with that one. Can you just maybe highlight what the business does?
Yeah.
And then we'll just roll from there.
Yeah, look, you look at their presentations and you're right. Like your first thought is this is an incredibly complex business, and it is in that sort of laboratory products segment. It's actually an incredibly simple business. So they're exposed to commodity producers primarily. So these guys, if I'm a miner and I'm exploring or digging stuff out of the ground and they know the grade or whatever of it, I do an assay test, which is just a tube of straight rock mineral. That goes off to the lab. It gets crushed into a fine powder. Some chemicals are then mixed in with that powder and heated up to some incredibly hot temperatures to create effectively a glass disc, and that goes into an X-ray spectrometer. So where XRF comes into that process is historically they've just been those machines that heated up to an incredibly hot temperature. They've expanded a little bit vertically into that chain and bought one of those crushing machines now, business Orbis Mining it's called. But the best way to think about XRF is they make lab machines that heat things to incredible temperatures and are then used to in that sort of assay testing. So they're exposed to mining. There's no doubt about that. The more testing and things like that benefits XRF, but the business is probably not as cyclical as what people believe, because I think when people think about mining and commodity cyclicality, they usually refer to the capex of exploring. So you think about your traditional mining services businesses that are quite cyclical. They need new explorers raising capital, coming to market, going out and drilling and creating new projects. That's not so much XRF. Most of their business is just ongoing mining. So, BHP, Rio, Fortescue, these big guys, they're continually, testing their mines and their product, and that ongoing just mining is XRF. So they do have some cyclicality at the front end. So last couple of years they've done well as that sort of junior mining sector has done okay. But the core business, like Australia, will continue to dig things up out of the ground for a long time, and that's been very steady even through the mining bust. The other aspect of the business I really like that I think gets overlooked is the consumable side of the business. So I mentioned before they put some chemicals that go into the assay that needs to be tested, and they sell these chemicals to clients over and over and over. So they'll sell a machine up front, but then the ongoing chemicals, and it's a very high margin segment, like mid 30% profit before tax margins. It's a beautiful sort of razor blade model. So it's one of the things I've always liked about XRF, and it's sort of a hidden jewel in that business, because they've got a very dominant global market share, like upwards of 50% in that sort of chemical space, which I think is sort of lost on the market a little bit. But that's the business in a nutshell. Like I said, it probably looks more complicated than what it is. Look, jumping into the report, I suppose, come through reporting season, revenue was up 24%. This is one of those businesses I said before, the headline NPAT was only up 17%, that net profit number, but there was some COVID benefits in that prior result. So I was saying before about adjusting last year's result to try and get a clean sort of comparison between the two. Real profits, if you want to call them that, were up 56%. So some good leverage over that revenue growth. The business, the other thing I really like about this business, which again, I think sort of gets lost a bit on the market, is the quality of their balance sheet. So you look at their balance sheet, there's about 50 mil in total assets. Even if you strip out some of their liabilities, there's about 20 mil in just real, tangible, solid quality assets. A lot of that is platinum, which goes into the manufacture of their machinery. They have some chemicals on their balance sheet. So lithium's a big input to their chemical that they use. So they've got some lithium on the balance sheet. They own their property down in Victoria, and they have a bunch of plant and equipment as well. So I think it's a very strong balance sheet, and the liquidation value I think is quite high. They could sell particularly that platinum and lithium back into some very liquid markets. So yeah, that's never been an aspect of the business that's worried me. Same with cash. Cash has always been brilliant. They convert their profits to cash fantastically. Like I said, this was a business that was one, you look at that outlook statement, on the whole, it was quite positive. The thing they did call out, though, is that lithium is a key input for them, and that big EV demand of lithium. So they've called out they expect costs to rise by a double-digit percentage. Now, what I like about this business, they've also said they think they can increase their revenue by that sort of amount as well. So to basically pass on that cost increase to their customers. I give them the benefit of the doubt that they can, because I followed this business for a while. I've owned it for a while. And they haven't put a price increase through to their customers for, I think, 2 or 3 years, certainly pre-COVID. So I think they've got some sort of latent demand there, the ability to pass on some price increases, particularly in this environment where I think customers are probably more receptive to it, because we're all aware of the headlines around inflation, and particularly commodity inflation. So going to your customers and say, look, price of lithium is up 10, 15% for us, we're passing that on. I think they have the ability to do that a little bit. So worth keeping an eye on, though, particularly because, you know, that lithium price hasn't really slowed down a great deal. I think maybe they were hoping for it to. It hasn't. So be aware they are exposed to that. And this is in that key consumable segment where those strong margins of 30, 35%, there's a lot of fat that could be eaten away if these lithium prices continue to boom like they are. So that's probably the key risk to the business. But overall, the outlook's quite positive. They have expanded quite well. And they were savvy enough to do it during the mining bust, which I think, we'll talk about Kit McGrath in a second, did a similar thing. A business who can time their CapEx cycles, I think, is a really attractive thing as an investor. So your traditional business, and mining's a great example of this, when we had the mining boom, when times are good, the natural inclination of a management team is to spend that money. You know, the money's coming in the door, let's go and acquire, let's go and expand, let's go and do that. And of course, everyone has that same idea. So your returns on investment are often very, very poor. And the mining boom was a great example of that. So businesses who can be counter-cyclical with their CapEx cycles. And so XRF, when the mining bust happened, that was when they began an expansion into Europe with their products, targeting more of the heavy industry segment like cement and glass and things like that. I find that very appealing. And so they're now coming out of that. So as that commodity cycle has turned for them, their CapEx cycle's also finished out. So you're seeing a real strength in the margins. And you see that they call it their precious metal segment. That's been the segment where margins have really expanded strongly over the last year and a half, and they're calling that to continue. So it's probably going a little bit in the weeds for people, but I think that's something, you know, keep an eye out on that, on how management allocates capital, but more importantly, when. The last thing you want to see is management's getting exuberant when times are good. You'd rather see them do that when times are poor. But yeah, look, I think, you know, they're calling out a couple of new products to be released, you know, sort of in that core laboratory range. But I think
I was going to ask you about that. Have they mentioned much? Do you have any insights into that?
I don't. They're very tight. They're very, very tight.
Yeah.
Even when I've spoken to them and they've done some meetings, probably some competitive stuff around that. So the most I've gotten out of them is that a couple of new products. One will be in that core sort of flux space of the you know, laboratory stuff. But the other one, they've sort of said it's similar technology, but in a different segment. So that's, you know, I attribute no real value to that, but it's certainly some blue sky upside if they can, you know, expand their addressable market into other segments. It's you know, something worth keeping an eye on. But overall, I thought it was a really, really strong result. Just pivoting again, bringing it always back to valuation, because you can talk about how good the business is. You've got to pay the right price. They did about I've got it here in front of me. They did 2.8 mil net profit after tax in the first half, growing strongly. So maybe that comes out to sort of high 5, 6 mil, trading on a 80 mil market cap. So, you know, about 13 times earnings, I think is pretty reasonable for this business, given all those characteristics we spoke about. And importantly, I think the growth, I think you'll see that multiple probably go from 13 to sort of maybe 10, 11 next year as that continues to grow strongly. So, yeah, I think that's fine.
Pays a modest dividend too.
Pays a modest dividend, so it ticks a lot of boxes for me. And you know, very not only a competent management team, but very conservative. I think you see that in the way they run their balance sheet. I have actually sort of quizzed them in the past of whether that's maybe a bit too lazy. They could, you know, leverage up with a bit more debt for sure. But the you know, the reply back to me is always a good one. And you know, I'll butcher the quote from the CEO, but it was something along the lines of, that's how a, you know, textbook MBA would want to run this business of you know, strip the equity out, level with debt. But a business operator, you know, when you're thinking 5, 10 years and the security of your business, you run it conservatively. And of course, credit to him. I was probably telling him that before COVID, when supply chains were hit very strongly. And this is a business that keeps, I think, 9-12 months worth of inventory on hand. So very conservative, pays a nice dividend, reasonable valuation. But I think the growth is there too, which I think is always important to have in any business, not just a micro cap.
Yeah, it's a great rundown, mate. XRF trades on the ASX under the ticker code XRF. Pretty straightforward. 80 mil market cap, as you said, or thereabouts. So it does tend to be a liquid for some investors. Obviously, you're very familiar with that, running a small/micro cap fund. But for investors out there and listeners, just keep that in mind, and you might want to monitor the liquidity position. But it's a business that probably doesn't get enough attention, I would say, because it's actually very high quality. It's one that we've recommended in the past as well. I could never figure out what these two new devices were. And I was waiting and waiting and waiting. And so maybe we just have to keep waiting until we find out, what it is that they launch. But really interesting business. You did mention that many investors' concerns are more cyclical in nature, given its resources, but there is a lot of staying power there too. Maybe we'll switch gears then. We'll jump across to another company. Maybe I'll talk about this one, which is Catapult Group, which is a business that many retail investors would be familiar with if they just watch the AFL or the rugby or some European soccer. Originally, Catapult started as a GPS wearables business, so for sports athletes and performance athletes and their staff could monitor fitness, monitor activity on the ground or on the court, and get insights from that. They then expanded into video analytics, which basically says, here's the camera, let's look down the ground. Think of like Telstra Tracker if you watch the AFL, something like that. Then they made this move, probably, which was a poor use of capital. They moved into the prosumer division, which is where basically they tried to take their advanced analytics from professional sports and apply that to semi-pro athletes or athletes that maybe are aspirational in nature. That didn't work, and the business has since been hit. We've got a new CEO at the helm, come from Audible, which is basically focused on driving subscriptions. One acquisition that they made recently was a company called SBG Sports in London. And what this business does is it effectively takes its dominant position in F1 sports and using analytics to predict, for example, if you watch the F1, when, say, McLaren might pass Ferrari. Is there a 52% chance that McLaren passes Ferrari in the next 3 laps or something like that? And so they've taken that technology and they're now trying to apply it to different sports. And under the CEO, Will Lopez, they're trying to basically bring together video and their other analytics engines and put it all in the cloud, and sell subscriptions into it. So I think I've got some numbers here just from the most recent period. And where are they? Here we go. So from the most recent period, there's this software as a service sales growth. They measure it as annualized contract value, which there are some criticisms of this metric, but ACV growth was up 43% year on year. And that was driven by both divisions, performance and health, that wearables division up 40%, tactics and coaching up 57%. Subscription revenue is growing fast at 29%. I think the thing that investors will want to watch from here, though, is basically their cost base. How do they're heavily recruiting. If you go to the Catapult website, you go /careers, I think it is, you will see how heavily they're investing in bringing data together with predictive analytics. So in the past, it's more like we'll capture the game, we'll look at the GPS afterwards, and we'll then get some insights from that. Then it became, okay, we can do real-time analytics. And now the next step is how do we then become more predictive with the analytics in real time to influence performance and coaching and tactics? And that's where we'll see a lot of benefit. Some of the big red flags I might also call out too for Catapult is it's kind of got a bit of a checkered history in terms of its focus on profitability. And its key competitor, StatSports, has been winning some of the biggest deals around the world. Many deals in the US, for example. I think there was $1 billion plus contract that StatSports won. And that would, if Catapult had won that, we'd be probably in the ASX 200, but it's not. So this business is really impressive. It's got really impressive technology. I think it may have squandered its first leader advantage over the years, but I really, really like the business for its sticky revenue. I would say there are risks on the horizon, being those costs. It has recently changed. You talked about kind of like subsidies muddying the waters, mate. It actually changed its reporting season calendar and its window. So we're currently dealing with a mixture of 9-month results, half-year results, yearly results, and we're trying to reconcile all that. But I think it's for the right reasons. The change of the year and the change of the reporting currency actually aligns better with the target audience, which is in the US and over in Europe. So that's Catapult Group, trades under the ASX ticker code CAT. There's a lot to watch. I think it's an impressive company. The acquisition of SBG will bolster growth, but keep an eye on that free cash flow and make sure you calculate it yourself. That's Catapult. Mate, I think maybe we've alluded to talking about Kip McGrath. I know Claude Walker, if he listens, he probably is a regular listener. He'd want us to talk about Kip McGrath too. Trades under the ticker symbol KME. Really interesting business, profitable, pays a dividend if I'm not mistaken. What does Kip McGrath do?
Yeah, it's probably one that people are familiar with. So Kip McGrath, you'd see their education centres around. It's a tutoring business. Previously was a pure face-to-face business, running, I think, lessons of 6 students at a time. They were making a slow incursion into online, but the uptake was very slow. I think the perception from a lot of students and parents is that online learning, the outcomes aren't as strong as face-to-face. So people, weren't quite willing to take it on straight away. But of course, COVID hits and you're essentially forced into online learning, not just in schools, but with tutors as well. So luckily, they already had their online platform in place and was able to take advantage of that. And the overall business actually held up really well through COVID, considering the type of business it is. So it was one I referenced before, talking about XRF, where you talk about CapEx cycles and the way businesses invest. And I've sometimes said, when you have a larger business, and even take Catapult as an example before, Catapult's a few $100 million market cap and a good chunk of revenue. They have the capacity to put on 4, 5, 6 mil of new employees and can sort of, they have the size to be able to do that. For a Kip McGrath at 60 mil market cap, when you flesh out your executive team, upgrade your back-end platforms and go through this sort of CapEx investment cycle, even a $2-3 million investment completely wipes out all your reported profits. And so to do that's a big decision, and when to do that's an even bigger one. And they did that during COVID, where COVID hits. Their top line actually held up okay, but the growth stopped. They were previously growing about 15-20%. And of course, when COVID hits it, everyone sort of just paused. But the decision to then embark on an investment cycle, and they fleshed out with a chief technology officer, a chief product officer. They upgraded their back-end center management software, implemented like Salesforce as a marketing software and some online booking software. So they've done that during COVID. So the reported numbers, like I sort of was talking about before, took a real hit in that period. But now the benefits of that will play out. That scalable platform's now put in place. The COVID recovery, fingers crossed, we're on the way out. And after 2 years of disrupted learning, students are able to finally refocus back onto where they need to be. And so Kip's well positioned, I think, to really see some fantastic operating leverage over the next few years. So the two things they've done, and I think, again, it's a pivoting business model, which maybe makes it a little bit more difficult to analyze for people. But the first thing they've done is that pivot to online lessons. COVID accelerated that. I think that's now entrenched. I think they've sort of said 20 to 30% of lessons will stay online. It's actually persistently stayed up around 35, 40. So wait and see. Maybe it does make its way back down. But I think that's now entrenched, and people have seen you're able to do online lessons and maintain at least, enough to make it comparable to going in face-to-face. It also has the benefit, it opens up their addressable market. So you think about what Kip McGrath used to be. If you had a centre in Tamworth, it was very difficult to get anyone who wasn't in maybe a 25, 50 kilometre radius. It's a long way to travel for an hour tutoring lesson. With online lessons, it just broadens that whole basin of where you can attract students from. So that's the other big benefit they see. But the other key change to this business, and it's one that I always love to see a business do it, it's go from a franchisee model to a corporate model. So previously, the whole business was franchisee. Every Kip McGrath centre you walk past would be owned by a third-party franchisee. Kip McGrath would provide some back-end support of obviously the brand, and they'd collect 15 to 20% of the lesson fees for the services they provided. But over time, if you decide to do a corporate strategy, you can pick and choose which centres you want to bring into your corporate business. And so, the centers that are doing well, the centers that have the, that maybe aren't optimized right, that if you were to purchase that, we can do some small things, change some things, and we know the strategies to optimize. And so you've seen it with a lot of retailers who have been franchised, and they slowly bring their best ones back in-house and capture that whole profit margin for themselves. And you leave the subscale or less optimized, in the case of KIP, usually your rural centers, to be franchisees, and you service them the way you always have. So this pivot to the corporate centers has meant they've had to bring in a lot of those costs up front. Like I said before, you've got to bring in an executive team, you've got to bring in a whole platform to be able to service, they've currently got 22 centers around Australia and the UK. But a lot of that's very scalable. Once you put those costs in place, the corporate center revenue can now scale over the top. So you go from capturing, like I said before, about 20% of your total lesson fee to now capturing the whole 100. So revenue growth's really strong. And now I think is where you'll see that profit growth really catch up with it, because you'll scale over that relatively fixed cost base in the background. So yeah, I think there's a lot to like about KIP. It to me feels a little bit where XRF was maybe back in 2017, 2018. You've had that investment period. You're now looking to leverage that and come out of it the other side and see that profit growth. And look, I think the other one as well is, not only is it a good business, steady business, has historically been profitable, pays a dividend. I've sort of alluded to it. You've had 2 years of disrupted learning. And I think schools, governments, and even parents themselves, I think everyone acknowledges that it will be difficult for the current school system, the way it is, to just completely pick up that slack, and that in some form or fashion, tutoring will have to do some lifting. So governments, New South Wales and Victoria, have already put plans in place, and KIP McGrath has access to school-based programs. But the real big one that they are eyeing off is they've just started a little tiny beachhead into the US, and that's their expansion plan in the US is through the school system. So it's a very low risk way of expanding. They started with like 3 schools in Arizona. That's now up to, I think, 9. And they're just expanding as the school contracts roll in. So they'll win a contract with a school to provide some tutoring services for students. It means you scale up with your revenue without having to do like a lot of businesses, you might have to spend $3, $4, $5 million just establishing, trying to build a brand, trying to, essentially put a business in place before it even exists. So the ability to scale up like that with the schools, I think, is good. And it's under that KIP McGrath branding too. So that's the big one, is at some point, I think, when the time's right, they'll pivot away from just the schools and replicate their Australian business model, but they're able to do it in a very low risk way.
It's interesting. A lot of people don't know that before Storm took over as CEO, I believe it was, KIP McGrath shares traded for 2 cents. The business was in this real tough spot because it had these legacy franchise contracts. Some of them were like $12,000 a year, fixed fees going back to KIP McGrath. And obviously, as the franchisees did better and demanded more of KIP, they were in a tough spot where they had to kind of unwind the franchise deals. And they're also like you said, they're repurchasing a lot of these territories, like in the UK, Scotland, etc. It's a really interesting business. I like it. I own shares, by the way, because I see it as kind of like there's 3 ways for them to grow. They've got the corporate centers, they can repurpose the franchisees, but then they've also got the US business as well. And I think there was a lot of criticism of them making that foray into the US with Tutorfly. But if you think about it, if you take a 3-year view, say, the acquisition makes a lot of sense because it's positioned between tutor and student. And like you said, the governments are focusing on schools and getting students to learn more and using tutors to do that. So it's kind of opportune time for them to make that foray. I thought it was really interesting. And yeah, I think under Storm's leadership, the business's execution has been pretty first rate. So pretty much first rate.
Yeah, I agree. And, it's always, I was actually chatting to someone this morning about this. You see it with different companies where you have a founder who's founded a business, decades ago. And when a family member or a son takes over, it can sometimes be an interesting dynamic. And KIP McGrath, when KIP ran it, obviously KIP McGrath is the name there. It was a much more conservative business. And I think over time, without disparaging KIP in any way, things sort of were done because that's the way they were done. And so when Storm shows up and has some ideas about where this business not only can go, but sort of where it has to go. Like his background was in tech, and I think he knew the future of tutoring would be online. So luckily he began that pivot before COVID. And understanding as well, the relationship between the franchisees was an important one, but one where I think you're right. The power had shifted to the franchisees and they had to bring that back. And I think going the corporate way has done that. It's shown franchisees, we can do this ourselves. So come with us, but we're not going to allow ourselves to be beholden to you. So I agree. I think he's done a really fantastic job. The share price reflects that from where it's been the last few years. Don't get me wrong, but on a shorter time frame of call it maybe a couple of years post COVID, it's sort of languished, I think. And I think a part of that is that dynamic I was speaking before about the reported numbers has been a little bit lumpy through this period as Storm's gone through his investment phase. But and I'm sure you agree with me as a shareholder. It's the ability to be able to see through that and see, again, I'll come back to it. I call it that underlying earnings engine. And so if I think about where Kit McGrath was 2 years ago versus today, the reported numbers, it would look like it's either gone backwards or gone nowhere, but the potential of those earnings, I think, has dramatically increased. And it's just, to bring an agriculture analogy into it, you're planting your seeds, and it's when you choose to harvest them is the big question. And I think that timing is pretty soon. I think you'll see it in the corporate side, maybe not the second half 22, but maybe FY 23. But it's certainly one. I love those styles of investment where the numbers are a bit muddy, but the underlying business has dramatically improved and the share price doesn't reflect that. That's where I think patient investors can just buy, hold, and just wait for the numbers. They'll come eventually. And when they do, the share prices will respond.
Yeah, Storm McGrath recently bought some shares, further strengthening the alignment to shareholders. But again, just a note here for listeners, just be mindful of liquidity. Kit McGrath, the company, KME is the ticker code, can be a little bit illiquid. So just keep that in mind. It does pay a little handy dividend as well. The next company, which I might jump on quickly, it's a company called National Tyre, trades under the ticker code NTD, sometimes called National Tyre Wheel or NTAW. It's an interesting business. It's probably not what you think. When people think of tyres, they think of Goodyear, Bow repairs, and getting their car serviced. This business is primarily a distributor of tyres. So it imports and then on-sells that to retailers. It does have its own retail arm called Tyre Right, and it recently made an acquisition of another business called Carter's. So these are like business to consumer, B to C, but typically it's B2B. And the business has grown largely through acquisition over the years. What's really impressive about National Tyre is it's maintained its cash flow in that time. It's used some debt, it's used some equity, but it's grown its business acquisitively. And when it makes these acquisitions, it actually brings on the founder or the CEO typically, which is a good move for the business. And it reminds us that these people want to stay around. These people run these businesses. One of the hardest things when you make an acquisition is the culture and the integration, and they've done a pretty good job of that under Peter Ludeman. The business has consistently reported incremental revenue as a result of these acquisitions, but it's also over the past 2 years had some favorable, extraneous variables. So things like currency movements in the right direction, good import-export environment. But what we're seeing now is probably a reversal of some of those things. So we've seen it make these acquisitions into a pretty good market, and it's established itself as Australia's largest independent tyre distributor, and also bringing in that retail arm. I initially thought when they acquired the Tyre Right business, I think it was part of Tyres for You, I thought that they would actually spin that off, but what they've decided to do is actually make that a franchise model, because it's not their core competency, while they focus on integration and building out this IT backbone. Basically, the business went through this period where it was really dependent on Cooper's tyres. That includes the Mickey Thompson brand. So people were really concerned when that contract, I think it was Goodyear, bought Cooper's, and they were really worried about that relationship, how that might sour. But basically what National Tyre and Wheel has done is basically said, okay, well, we're just going to grow out of this. We're going to grow so big that, all of the tyre suppliers and manufacturers have to work with us, and we have to be able to push that through our network. So by building itself out vertically, then also having some distribution footprint to consume the consumer side, and also dominating things like mining, forklifts, agriculture, it's basically like entrenched itself in the ecosystem in Australia. There were a few things that stood out from the recent results. It is experiencing higher import prices because of the weaker Aussie dollar, and the rubber costs, I believe, are up too. So there's a material cost there. Shipping costs, we all know, have gone up through supply chain bottlenecks and so on and so forth. I would expect to see higher inflation in the second half hitting some of those wages. That line item for wages that they have, while they are ripping out some cost due to synergies, that we'll probably see that go higher. They increased in response to, and this has been pretty common across the industry actually, in response to supply chain issues and inventory, they've dramatically invested in net working capital. So their cash flow isn't looking quite as crisp as it normally is. The shares fell about, I think off the top of my head, about 20% on reporting day. So one of those big volatile ones that you were talking about on the downside. Some of the things that they can do, however, now that they've made a number of these acquisitions of Tyres for You, Black Rubber and Carters, is they can use their own network to push their own volume through, which they haven't been able to necessarily do in the past. So say if they have the retail arm, they can fill shelf space with their own inventory, and they can start to push that through there rather than be beholden to retailers and just getting what the manufacturer sends. So there are many organic levers that they can pull now. I think some of the concerns might be around, well, hey, in the past you said you're going to make all these acquisitions, and now all of a sudden you've shifted to, we're not making acquisitions, we've got debt on the balance sheet, we're going to go in a different direction and focus on the organic side. I think it's the right time to do that. I think they should be doing that right now. I think the move to kind of diversify the tyre business and focus more on their distribution is really interesting. They made an acquisition of a company called Black Rubber, which I'm not sure how much you know about tyres, mate, but I didn't know a lot before I got involved with National Tyre. But one of the things that they can do is they can actually do deals like kilometres. So they can price tyres and form enterprise kind of wide or company wide deals with fleet companies and whatever to basically charge a fee on like a per kilometre basis, which is really interesting for tyres. Electric vehicles, by the way, also use rubber tyres. So just in case people are wondering, what's electric vehicles going to do this? But what they can do is through their retreading business, they can now push all of their network through the retreading businesses that they bought, which lowers costs and allows them to share that IP across the teams. The company pays a dividend, but obviously that's dependent on cash flow being stable over the next 24 months. I think it should be stable, but fully franked, good dividend. I used to, when I did a valuation on this, I actually used a 15% discount rate, which is probably fair. Maybe you could go a little bit higher, maybe a little bit lower, depending on your view of the risks from the macro, and a 1% terminal growth rate. And I think it's still reasonably priced at these levels, even if you get a decent dividend and modest compounding. I think Peter Ludeman, who has, if I'm not mistaken, AMP Capital background, really good capital allocator, seems to be strongly aligned to the business, and lots of those founders still entwined with the business too. So National Tyre, it's not without risk. It's a bit of a hairy one. It's one of those kind of acquisitive roll-up / really deep value plays. You have to do your numbers carefully, but I think it's an interesting one, at least for the watch list. And as we see this next 6 months play out, just keep an eye on those wages and basically how those costs expand. We want to see those under control. But NTD is the ticker code. Interesting business, offers yield and modest growth. I think that's number 4, Luke. So now we've got one more. And this company that you're about to bring up is a company I think I looked at, and the irony is I think I looked at it when you and I may have been on AusBiz together. For the call at lunchtime one day, and I didn't know anything about it, and I did a little bit of cramming for the show, and now I still know that little bit about it. So I'm hoping you can fill us in on what Earlypay does. EPY is the ticker code.
Just quickly on National Tyre, I like the business, and I think it's in the right space. Distributors can be brilliant businesses, particularly in that nice little niche, and I think I agree with a lot of your comments there around the key to a good distributor is a very competent management team. And I think these guys have been listed long enough and being through COVID to demonstrate that. And more importantly, I agree with your point on the balance sheet. I had a quick look. I think it's sort of at a level now that's comfortable. It's about 1x net debt to EBITDA. You could probably, if they found some aggressive lenders, you could probably take that to 2. But I think you're right. I think this is the right time to now squeeze what you've acquired and get those organic synergies. And it's one that, I pretty much agree with everything you said. It's got some risks to it, but for the right investor, I think you've got a good management team at the helm to sort of steer that ship through them and do okay.
Yeah, it's all about position sizing, rather,
exactly.
with something this size. So yeah, it's not without risk, as I said, but it's a really interesting play for yield and maybe some modest growth as well. Just keep an eye on those extraneous factors, I guess. But Earlypay, mate, tell us a bit about this.
Yeah, so look, Earlypay, it's by far the worst named company in my portfolio. This is the old CML group that does invoice financing for small businesses. So Earlypay, of course, you've had Before Pay come to the markets, and I think your first inclination when you see Earlypay is, it's another buy now, pay later, but it's not. So these guys, if you're a small business and you've sold some goods to usually a larger business, and they may pay you on 60, 90, sometimes even 100-day terms before you actually get your cash. These are guys you can go to sell them your invoice, and for a certain amount, they use some AI in the background to calculate exactly how much. They'll buy your invoice off you, so you get cash up front in the door. So it's a very simple business. Factoring's been around for many, many years, millennia maybe, and they do it well. So this is a business, like I said, used to be CML Group, been listed for a long time. It was doing very well until COVID. So if you look at sort of their net profit up until COVID, it had just grown steadily year on year from sort of 1 mil up to nearly 10. COVID hits, of course. COVID, in hindsight, I think COVID's been such an interesting time because at a total societal view, I think we've sort of gotten through COVID not too bad compared to what you maybe would have thought when it sort of first hit. But at a micro level, and particularly small business in Australia, there was some big hits. And looking back, that's probably the biggest paradigm shift we've had through COVID. I think a lot of power or split between small business and big business shifted to big business, who were larger, better access to capital, better access to survivability through COVID. And you've probably seen that impact a small business, which fingers crossed can come back strongly. But nonetheless, these guys exposed to small business. So that profit really stagnated through FY20, FY21. And then I think we're finally seeing that, big pent up snapback from COVID. So this first half result, out of the three I've brought, and even probably my whole portfolio, it was by far the best result I'd seen. So these guys did just over 7.5 mil net profit, which is basically, they did 8.5 mil the whole of last year. So a very, very strong first half result. They upgraded their guidance, and it was the third time they've done that. So when they first came to market at the end of their FY21, they said, we think we'll grow about 40% profit in FY22. At their AGM, they then changed that to, we think we'll do 50% profit. And then now they've come out and said, we'll do, 15 mil, which is roughly about 70% profit. So you're seeing the momentum of this business increasing very strongly. And again, it comes back to, you'll probably see this consistent theme across the three companies I've mentioned, and you'd see it across most of my portfolio, but, conservative, competent management teams. So, despite doing over 7.5 mil in the first half, and second half is generally seasonally stronger for them, they've only guided to about 15. So it's not hard to see they'll probably end up beating that guidance again quite well. And I'm sort of modeling out maybe somewhere between 15.5 to 16 million at the end of the day. Only currently trades on about 130 mil market cap. So this is one for the deep value out there. This is like sort of, probably 8 to 9 times earnings, with very strong growth. Again, dividends, cash flow. You'll see that consistent theme across pretty much everything I talk about, I suppose. So that core business is where all the growth's coming from, that invoice financing business. It grew 24%. It had some good control over their expenses, which only grew 21%. As they get bigger, and you see this with a lot of finance companies, like if you were to look at maybe a MoneyMe, a Wiser, some of those guys, as you get bigger, you can negotiate better terms with your lenders. So their cost of interest is coming down. It widens that operational leverage even more. The reported numbers, they had the benefit of a lower tax rate, which will normalize, but even stripping out the tax effect, still grew sort of 35%, which is really strong.
How about sorry, Luke, just interrupt. How about the things like losses and their kind of their risk management?
Yeah, it's a very good point. So again, like it's always important for a business like this. So this is a business where you've generally got a very strong asset backing the lending. So you've got, an invoice that's already been created, like I said, usually for a larger customer. And so their loss rates, they say they're sort of less than 10 basis points. So it's not a business that has to manage. So when I compared it to a MoneyMe or a Wiser before, those guys are direct consumer finance. That's a space where I'm a little bit wary on that space, because I think you've been through 2 years where consumers have been quite subsidized by the government and consumer balance sheets are quite healthy. Yeah. So I sort of take their loss rates with a little bit of a grain of salt. But for these guys, the quality of those assets that are backing the loans, I think, their loss rates have never been a big issue for them. Because keep in mind, they're not financing the small businesses directly. They're just financing the receivables that they have. So even if those small businesses are struggling, that's still a legal claim they have to the receivables on another customer that they've issued that to. So, they do have one thing I will call out. And again, I was talking about XRF before and sort of how you ascribe value as an investor. They do have a direct equipment finance book. So that's one where if I'm actually my wife used to run a cafe. We have a cafe, we have our coffee machine, costs a few $1,000s. You can get that financed and just have lease payments instead. So that's one of their segments. That's one that I'm not as fussed about, to be honest. It's an area that the history of the ASX is pretty checkered. You might remember Silver Chef a few years ago.
Of course.
Access Today popped up for about a year in that same space before they blew up pretty spectacularly. Because you're exposing yourself much more to the underlying health of the small business that you're servicing. They need to be able to service these equipment financing, but it's a very, very small part of their business, and by far the earnings engine is driven by that core receivables business, which I think is doing really, really well. So look, like I said, I thought it was one of the better results I saw. It was just an explosion of organic growth. A lot of that I think is just pent up COVID demand, but management have sort of said they've seen the second half 22 continue. As they get bigger, they're able to, the constraints of their growth sort of get removed, because they have warehouse facilities with their lenders that can only lend up to a certain amount. They expand, so they can now grow faster. And they actually only announced that the other day, I think yesterday, that they'd increased their warehouse facility. I think, again, it's a very well-run business. You need that. Anytime you play in the finance space, I think you've got to have a really strong view on the management team and their conservative nature, because lending is such a tough business. Bear in mind, again, we'll get into the weeds a little bit here. I'll try and keep it a little bit high level, but when you lend a small business or a consumer money, the profit you recognize up front is effectively what you want it to be. So the accounting standards essentially let you take a predicted loss on that, and then across your whole book, whatever's left is your reported profit. So always keep that in mind, that you've got to have a strong view on how management approach their book, how they're lending. Fast growth, even though I've been talking about Earlypay growing fast. It's incredibly easy to grow fast as a lender of money. All you have to do is give people a lower interest rate, and you'll generally grow faster than your peers. But it means you're taking on potentially more risk. But again, I've known this management team for a long time, spoken with them, and followed them for a long time. I've got a lot of comfort around their competency and how they grow their loan book and their business, and you see that in the historical results as well. So I thought it was a fantastic result. I think they'll come out and actually beat that guidance that they've put out to the market, and probably trade on maybe 8 to 9 times earnings with some good growth. The big risk, I suppose, and it goes into what you were just talking about with National Tyre, is the underlying exposure to small businesses in Australia. If this is a double dip recession, we've already seen what COVID did to their volume numbers and their profits. That similar thing could happen again. So bear that in mind. Again, it goes back to what I said. I don't invest because of macro, but for a position like Earlypay, you have to be aware. You have to sort of have your finger on the pulse of where you think the economy is at any one time, roughly, and maybe even more specifically, the trajectory. Are things doing well? Are things maybe starting to turn? What are the headwinds? and for these guys in particular for small business. But yeah, putting them to the side, I think the valuation you're getting, I think, compensates you for all that risk and then some.
It's a really interesting business. When we looked at it, when I quickly looked at it for AusBiz, I was surprised by how clean the financials were, which you mentioned there. You don't often see that so early when a company's growing like that. You don't see that very often. So that was refreshing, actually. And the name, I guess the name is a bit scary in these times, but I think it's a really interesting business. So that's Earlypay, EPY, and is the ticker code on the ASX. Mate, you've brought some really interesting companies. I know you invest in a very deliberate way in these profitable, not speculative companies. Avoid biotech, avoid resources, which I think that's the way I invest too. So I mean, you're preaching to the choir here. Just to recap, we covered Kit McGrath, KME is the ticker code, Catapult, CAT, Earlypay, EPY, XRF Scientific. That was a great overview of that, by the way. XRF is the ticker code, and National Tyre Ltd is the ticker code. Mate, we've got merewethercapital.com.au. How else can people get in touch with you? Let's say if they want to ask a question about some of the companies that have come up today or even invest.
Yeah, reach out on the email, investors@merewethercapital.com.au. I'm on Twitter at Luke Winchester 9. I'm pretty prolific on there. So if you shoot me a Twitter message, I'm sure I'll see it. They'd reach out in that channel and more than happy to provide any more information on the fund or just chat about stocks if someone has a question about any of those three companies or something else they may have seen. You're familiar with me through AusBiz as well. I just love talking about companies and what I'm seeing out there in the market, so more than happy to always pick up the phone or shoot an email to someone.
Great. Yep, I'll put all those links in the show notes, mate, as well as a link to the original conversation that you and I had. So Luke Winchester from Merewether Capital, thanks for joining me today.
Thank you, mate. Really appreciate it.